We all have one in our wallet. But what is it, really? Welcome to The Explainer. Today, we're pulling back the curtain on the credit card. Because it's not just a convenient piece of plastic, it's a meticulously designed gold mine for banks. And we're going to break down exactly how they strike gold.
I mean, seriously, have you ever actually stopped to think about it? This card, which you probably got for free, is the engine of a multi-billion euro industry. On the surface, it's also simple. You swipe now, you pay later. But underneath all that, it's a complex system, a maze, really, built for one primary purpose, to make banks an absolute fortune. So, how does it all work? Okay, let's open up the playbook. First up, we're going to see how your balance is literally their business. Then, we'll get into the surcharge that happens on every single swipe. After that, we'll cover the whole universe of fees, the invisible profit engines you don't even see. And we'll finish up with the one smart takeaway that puts you back in control. All right, section 1, your balance is their business. This is the absolute bedrock of credit card profit, and it all boils down to one simple, powerful word: interest. You see, the magic trick here is something called revolving credit. Think about it this way. A car loan, a mortgage, they have a finish line, right? A credit card doesn't. It's designed for you to borrow, pay a little bit back, and then borrow some more, all while that unpaid balance just sits there. And that balance, that's the fuel for this entire profit machine. And here's where things get kind of wild. Just look at the cost of borrowing this money. A mortgage for a whole house might cost you, 4%? A car loan, maybe 7%? But that little piece of plastic in your wallet, we're talking 20, sometimes even 30% interest. You're paying an absolutely unbelievable premium for the convenience of instant, unsecured debt. And this, right here, is why that minimum payment option even exists on your statement. It feels helpful, doesn't it? Like they're cutting you a break. But it's really a trap. Paying just the minimum on, say, a €1,000 balance can keep you paying for years, racking up massive amounts of interest along the way. It is the bank's absolute favorite way to maximize their profit on your debt. But, the interest you pay is only chapter 1 of this story. Banks have figured out how to take a cut of every single purchase you make. Yeah, even if you're one of those people who pays their bill in full every month. It's called the interchange fee. And every time you use your card, there's this little financial dance that happens in the background. You pay the merchant, but before that money ever gets to their bank account, the bank that issued your card reaches in and takes a small cut, usually somewhere between 1.5% to 3%, just for processing the payment. So let's put that in perspective. On a €100 purchase, the store you just walked out of doesn't get the full €100. Nope, they might only see about 97.50. That missing €2.50 gets sliced up by the banks and the payment networks. Now, it feels like pennies, I know, but multiply that tiny slice by billions of transactions happening every single day around the world, and suddenly you have a massive river of gold flowing straight to the banks. Okay, so we've got interest and we've got swipe fees. What's next? Well, next up, a fee for everything. Because beyond those main revenue drivers, banks have cooked up a whole menu of charges for all sorts of specific situations and services. Let's start with the most obvious one, late fees. Miss that due date by even a single day and bam, there's a $40 penalty. It's just pure, simple profit for the bank, punishing a tiny mistake with a pretty significant charge. And believe me, the menu is long. You've got annual fees for those premium cards, sometimes costing hundreds of euros a year. Then there are foreign transaction fees that skim a percentage of every single purchase you make abroad, cash advance fees for using an ATM, which is an incredibly expensive way to get cash, by the way. They even charge you balance transfer fees just for moving your debt around. Every single one of these is a carefully crafted revenue stream. But the playbook doesn't stop with the charges you can actually see on your statement. Let's look at the invisible profit engines. This is the value banks generate that you never directly see. So think about those rewards programs, the airline miles, the cash back. They feel like a gift, right? Like a free perk. But they're not. When you earn airline miles, it's because the airline has paid the bank a partnership fee. They're paying for access to you. So you get a small perk, sure, but the bank gets paid, and you're now incentivized to spend even more to get more points. It's this brilliant loop where, in a way, you become the product. And then there's the data. Your spending habits, what you buy, where you buy it, when you buy it. When all that is aggregated with millions of other people and anonymized, it is incredibly valuable. Banks use these insights to spot trends, to design new products they know people will want, to target their marketing with laser precision, and to form new partnerships with retailers. It's a hugely powerful strategic asset. So after breaking down the bank's entire playbook, from the interest charges all the way to the data, what is the single most important thing you should take away from all this? What's your winning move? This is it. This is the most powerful way to completely flip the script on them. Pay your balance in full, on time, every single month. If you do that, you shut down their number one profit engine, interest. You get all the convenience, you get all the fraud protection, and you essentially get to use their entire complicated, expensive system for free. So the question is pretty simple. Now that you've seen the entire playbook, how are you going to play the game differently? Because understanding how the system works isn't just power, it's money back in your pocket. Thanks for tuning in to